Hello, everybody. This is Leo Kelly, CEO of Verdance Capital Advisors, and I'm coming to you today with a coronavirus update. It is March 30th. The markets are up slightly today after a weekend full of news. And so we thought we'd bring you up to date on where we are with the virus, with the economy, and with the markets. It's been an interesting past week. The news flow is starting to get to that stage where it's extremely stressful. We're seeing corona cases rise. We're seeing these terrible images coming out of New York, flashpoints coming up in other parts of the country. And so the anxiety level is rising. And unfortunately, we have to stay home and there's no sports on TV. So what do? We watch this news. Now, that said, as bad as all this news is, the stock market went up last week, and bonds actually did well last week. And so there's this divergence between news flow and markets. And in fact, that's always a good sign when markets can go up in the face of bad news. So let's talk about what's happening. In the economy, we're in a complete shutdown. It's actually, if you see pictures of New York City, it's somewhat eerie to see an empty city all day long. And that's the nature of what we're dealing with, a total shutdown in the economy. We got some data last week, 3.3 million new jobless claims, a record by far expected from this complete shutdown and this sequester, if you will, of people staying at home. And so now we have to deal with the rebuilding of the economy. By the way, the day that 3.3 million was announced, the stock market went up. And I think that's a combination of the fact that there's employment benefits, which we're going to talk about, and the fact that if they're not at work, they're home, and maybe that brings us to a faster end to this whole crisis. Surveys, manufacturing surveys are as bad as they've been since the Great Recession. That makes sense. If the market's shut down, it's hard to have optimism about the future. The GDP for the first quarter will be negative. Now we know that. Second quarter is going to be terrible. It could be as 20% down. It's going to be a big number. Now, what we know about shock events to the economy and the stock market, they tend to be fast, they tend to be deep, and the good news is they tend to be V-shaped. Now, we never know how this is going to end, and we don't know what the bottom is, but what we have to do is we have to go by history, and we have to continue to look at the impact of the economy on all this. So as we enter this period where things are shutting down and people need to make payments and the worry is starting to build, and we look at the impact of all this on the markets, it makes sense that we've just had the fastest bear market in history, the fastest run down that we've ever seen, a relentless move down without much oversold rallies to give us a little relief. Credit spreads widen in the bond markets. A spread is the amount of money you're paid for your bond relative to a treasury. So when risk is low, we don't need much of a premium because everything's fine. But when risk gets high, we demand more return. We want a higher rate of return on our bonds relative to the safe treasury, and those spreads got really wide. Commodities are down. Bottom line, hopelessness took over the markets a couple weeks ago. And yet, despite all this, despite the bad news in the economy, despite the bad news in the coronavirus, last week we saw a tremendous rally. In fact, over a 3-day period last week, the market went up 20%. It's the largest move since the Great Depression, an incredible rally. We actually ended the week plus 13%. Again, one of the largest moves since the Great Depression, right in line with a 2009 move coming off of the Great Recession move down. So stocks rallied. How is that possible? And the answer is the market is starting to look ahead. They're starting to look at some different data points, and they just think maybe that market got a little oversold going down. Now, that doesn't mean we're at a bottom. We have to make sure we understand that these markets can bounce around and volatility is not over. And we're not trying to hit the V at the absolute bottom. That's an ego game. That's not an investment game. The key is to buy gradually going down and back up again and stick to our discipline. Bond markets improved dramatically. Those spreads we saw come together and start to close a little bit, which shows us a reduction of risk. Just to give you some numbers, the high yield market or junk bonds were 11% over treasuries. They came down to 9%. And if you take energy out, 8%. So that's a nice move. Still a little high, but a good move. Investment grade bonds went from 3.5% higher to treasuries to under 3. Again, a positive sign. And the shocking one was municipal bonds, 6.5% above treasuries, and they're tax-free, and those came down to about 3% last week. So what's happening in the market to cause this optimism? Well, as we said, first of all, a little bit oversold conditions. But obviously the big news was passing the CARES Act, this giant stimulus bill, $2 trillion. I have to say the number again, $2 trillion worth of stimulus. The entire U.S. GDP is approximately $20 trillion. So if we think about GDP going down for 20% for one quarter, and we're going to fill that hole in with $2 trillion of stimulus, this is a significant number, not something to be looked at lightly, and the market isn't. What's in that? Direct checks to folks making under $100,000 single or $200 for married, unemployment bonuses that will be extended and enhanced. So there's those 3.3 million people getting money so that they can continue to live. Loans to businesses, and those loans, there's a lot of incentive to keep employees on the rosters and keep people working. So when everybody comes back after this snapback, we're ready to go. Industry bailouts. So the airline needs help. Now, what we know about these, bailout is a term, but what it's going to be is an investment. The U.S. government's going to invest into those businesses. This happened in 2009. I know taxpayers hated the 2009 bank bailouts because they were so distasteful. But taxpayers didn't spend their money. They invested, and they got a very handsome rate of return on those bank investments. We're hoping for the same here. Evictions will be halted. There's a lot of tax benefits here. They're talking about now doing to help restaurants to give full deductions for entertainment and restaurants for businesses. There's a lot happening here. The Treasury is very active. The Fed is also very active. They've already intervened and put a tremendous amount of liquidity in the market to help shore up these bond markets and commercial paper markets. They're working with Treasury to put out these loans. Now, remember, the Fed takes $400 billion from the Treasury, gives it to the banks, and can loan 10 times that number. So we're talking about trillions of dollars of liquidity available to the system. It makes a difference. And yet, the Fed has already told us they have plenty of ammunition still ready to go, and they will use it. And this is the big difference between 2009 and today. In 2009, the Treasury and the Fed hesitated. They were concerned about this moral hazard. They're not hesitating right now. They're throwing everything they can. And regarding some questions we get about depression, this is not the Depression. What caused the Depression was the Fed and the Treasury did the exact worst things at the moment of stress. They contracted money supply. They fought the whole system. They put and closed out foreign products coming in. Just the opposite now. We're actually ending the tariffs, or at least temporarily suspending tariffs with China. Finally, the virus, we're getting some better news around the virus. While things are bad and numbers are expanding, we're testing exponentially more than we did. Abbott Labs just came out with a test that we can know what's happening in 5 minutes. There's going to be more and more of that hit. The more testing, the better off we are. We're starting to just see some trend changes where hospitalization rates are not quite as bad as we thought they would be. Some of the death rates are not quite as bad. Doesn't mean they're good. Doesn't mean it's not tragic, but we're trying to change the trend. And finally, therapeutics. There's some really promising data coming out on several different therapeutics that are slowing this thing down. We're hoping we're going to get vaccines or therapeutics to help our cause here. The news is very good on this side. Yes, we have to go through testing, but remember, there's two parts to this. Get through the moment and make sure we don't have another one. And we're getting good news on both parts of that. And so we'll tell you to hang in there. So in conclusion, what we're looking at here is slowly starting to get better and better news. It's not good yet. We got a long way to go. There's a lot of road to hoe. But I will say this. I have never seen anything like this. We believe in the American spirit. We're seeing industry come together. They're making ventilators. They're making masks. They're donating. They're putting everything they can at this. We're coming together for one common cause to fight one common enemy. None of that is more prevalent in the whole healthcare industry. Pharmaceuticals, biopharmaceuticals, they're all working on the tip of the spear to find an outcome that stops this common enemy. And I mean, you just can't say enough about the frontline workers, the healthcare workers, the doctors, the nurses, the first responders, the supply chain folks driving the trucks. These people understand that there's a responsibility beyond what's your immediate world. And just like we always do, we are responding. We'll get through this. There's a lot more work to do here. I know sometimes it gets a little disconcerting. If you have questions, pick up the phone. We're here. We're using the data. We're being disciplined in our asset allocation, and we're going to continue to fight our way through this. We'll get to the other side of this. Thank you.